So this video is dedicated to Mr. Pramod Namdar. He's become like a friend now because he regularly sends me email. I study his emails, I reply to his emails. Now this is something that I am late to reply to. I must have replied on this email to Mr. Pramod, but the video time has come now. It's like I got this email on 23rd of September. It's been a while since I was planning to reply to this email using a video. See, I have flagged this in my email system. So I'm sorry I'm replying late, but it is worth discussing. So he says, Hi Rohit, good evening, sir. Recently, I have observed that a couple of stocks are split due to various reasons. So I wanted to ask how a professional trader or investor should react to such situations. Well, the answer is very simple, don't react. Because a stock split for me is a non-event. If a stock has face value of 10 rupees and if they split it 10 pieces for every one, then now the face value is 1 rupee per share. But the share price will also adjust, right, to reflect that split. So, for example, if a stock is worth 1000 rupees and they split it into 10 parts, now every part is worth 100 rupees. I'm talking the face value. Similarly, market value will also adjust accordingly. One positive thing that could happen when a stock split happens is that if a stock is, let's say, priced at maybe 10,000 rupees per share, now they split it to 10:1. Now every share is worth 1,000 rupees. So some people might not be willing to buy a stock at 10,000 per share, but the same people might be willing to buy a stock at 1,000 rupees per share because the price per share has gone down. So the liquidity in the stock might go up. But even that would be temporary, right? Overall, the people who move the markets are the big domestic and foreign institutional investors. For them, how does it matter if the price of the share is 1,000 rupees or 10,000 rupees? It is only for the retail investor that the retail investor will look at whether the stock is a 4-digit stock or a 5-digit stock. But for the big guys who move the market, this really doesn't matter. That is why stock splits are a no event for me. It is not an economic event. It is an accounting event. A good event, a good accounting event is when they do a share buyback. Because in a share buyback, you are using the money from the treasury of the company to extinguish some shares. So the total number of outstanding shares get reduced. And now the profit of the company is spread over a less number of shares available in the company, the outstanding shares. So now the EPS of the company would go up, right, per share. That's a good accounting event. This is a no event kind of an accounting entry. It doesn't make much difference to the company. It's just that some more new names will get added to the shareholder list. That's it. Liquidity for some time might go up into the stock because now the stock is cheap and people feel like, okay, now we can get an entry into the stock. There are some stocks in India that are very expensive. Some are in 6 digits, right? Some are in 5 digits, high 5 digits. So in those cases, stock splits could add value. But the answer to this question is don't react. It doesn't make any difference. Even if you're a trader, the price and everything will adjust. Okay. Only thing you might have to change is the stop loss order and the GTT order that you had put in. You will have to modify it accordingly. That I think you can do. 2 months. I remember that I had bought a stock in April, like 15th April, I bought BSC. I bought it at 6,000 rupees roughly. Then they gave two bonus shares. A bonus and stock splits are different, but the bonus shares, it was like one share became three shares. So this price went from 6,000 to 2,000, right? That happened with me. It does even bonus doesn't make much of a difference, right? It's not that you're receiving something new. Okay, it's just capitalization of cash. That's what bonus is all about. If you didn't understand that, then forget it. Okay, it's financial. Don't get into that. But I'm just saying that splits bonus don't make much difference to me. What makes a difference to me is a stock buyback, because that's a real management decision, okay, to reward the existing long-term shareholders. Even Warren Buffett is very fond of uh, share buybacks. Warren Buffett, Peter Lynch, Charlie Munger. I have studied all of them, by the way. It's not that I'm a follower of William O'Neill, Mark Minervini. I have studied Warren Buffett. I have studied Benjamin Graham. I have studied Charlie Munger. I have studied Peter Lynch. I have studied Phil Fisher. Fantastic investors. I like their philosophy. There is a place for that philosophy, but I feel William O'Neill philosophy is more objective, in a sense that if you want to become a value investor, you have to really become an investigative journalist, which is not in my personality. So if you like a company, then you have to not only understand the company, understand the numbers, you also have to talk to the customers of the company, the former employees of the company, the vendors of the company. You have to check whether the company has any contingent liabilities, any legal issues that they are facing, any compliance issues they are facing, any regulatory concerns. Too many things to check. So you really have to become an investigative journalist to dig deep into the company. But when it comes to William O'Neill and Mark Minervini kind of criteria, we only look at four things: earnings, sales, return on equity, and margin. And based on that, we take a decision by looking at the chart. So I feel the William O'Neill and Mark Minervini system is more objective. The Warren Buffett system definitely makes more money than William O'Neill system, but that takes a lot of work. You have to sit and read annual reports like crazy. Thankfully, we have artificial intelligence tools where you can upload the annual report of a company and then start asking questions, and the chat GPT will start spitting out the details that you want. So now we have reached a stage where it's not about your annual report reading skills, it's about the quality of the questions that you ask to your chat GPT. Okay. And that doesn't, chat GPT is not a replacement for the scuttlebutt approach. The scuttlebutt approach is an approach, I think it is mentioned in the book Common Stocks, Uncommon Profits by Phil Fisher, where you do a proper analysis of a company by talking to a lot of people, even talking to former employees of the company to really understand what goes on in a company. Coming back to the email, 2 months back, Ashok Leland went to split, and without knowing that there was a split, I had trimmed down my position size by 75%. For your information, I had entered the trade based on positional. So it's okay. I mean, 2 months back, Ashok Leland split, and without knowing that there was a split, I had trimmed down my position. So I think before the split, he had trimmed down the position by 75%. So there was no way he could have known that there was a split coming. The management will announce the split, only then you come to know, right? So this is a non-event. It doesn't matter whether you sell before the split, after the split. As I said, it's a non-event. It's only the face value that changes. Maybe for temporarily, some liquidity might go up, the stock might go up an additional few percent up extra, but in the long run doesn't make much difference. Okay, so don't worry about stock splits and bonuses. If you really are excited about a stock, then it should be a stock buyback. So if you take a trade like a swing trade or a positional trade, and after you take a trade, the company announces a buyback, well, now my risk in the trade has gone down. So I can give it some more room to fluctuate. I will not increase my position size, but I will not trim down my position size as well. Okay. Thank you so much.